What you're doing right now, put down the coffee, mute the television, close the trading app. Because what just happened in the silver market is not volatility, it is not profit-taking, it is not healthy consolidation. What you are looking at is a crime scene. While Bloomberg was telling you markets remain calm and CNBC was gaslighting you with their smiling anchors, the CME just pulled the emergency lever and detonated an 18% margin nuke on silver. And that single line of code may have just killed the $80 breakout in broad daylight. This is not how free markets behave. This is mechanical execution. They change the rules in the middle of the game. Again, every time silver begins to move into escape velocity, the casino lights flicker. The pit bosses run to the back room, and suddenly the entire building is under maintenance. The price doesn't move because of supply and demand anymore. It moves because the algorithm is ordered to move it. This is not trading. This is financial warfare. And here's the part they don't want you to understand. Margin hikes are not about protecting market stability. They're about forcing liquidation. They're about shattering momentum. They're about triggering cascades selling inside a fully leveraged derivatives tower that is already cracking under its own weight. This is how the rug gets pulled. When silver was pressing toward the $80 handle, the psychological, technical, and structural escape hatch, the banks were cornered. Their paper shorts were bleeding. The physical market was screaming. The vaults were draining. And right on schedule, the casino flipped the switch. Boom. 18% more collateral required. Overnight. No warning. No debate. Just mechanical enforcement. If you don't understand why this matters, then you don't understand the game you're in. The entire precious metals complex is a rigged casino built on paper, promises that cannot be honored in physical reality. Every contract is a claim on metal that does not exist. Every ounce traded is rehypothecated 10 times over. Every rally threatens to expose the fraud. So they don't let the rally happen. They don't allow price discovery. They allow price control. This is not capitalism. This is not a market. This is a derivatives containment chamber designed to prevent physical metal from repricing in a collapsing monetary system. And tonight, you're watching the system malfunction in real time. This margin nuke was not defensive. It was not reactive. It was pre-planned. They saw the breakout coming. They saw the liquidity evaporating. They saw the shorts losing control. So they fired the only weapon they have left, forced deleveraging. That is why silver reversed violently. That is why open interest is imploding. That is why the charts now look like a heart monitor in an emergency room. This is the phase of the cycle where the lies get louder, the moves get more violent, and the exits get narrower. This is the phase where paper dies. And if you are still holding digits instead of atoms when the next wave hits, you are not an investor, you are collateral. What you're watching on your screen is not market behavior. It is mechanical execution. The move you just saw in silver was not emotional, it was not discretionary, and it was not driven by human decision-making in real time. It was triggered by pre-programmed kill switches embedded deep inside the derivatives plumbing. This is how the system actually works. The public narrative is fake. The price path is engineered. Bloomberg will tell you traders took profits. CNBC will tell you risk-off sentiment returned. Reuters will tell you investors digested macro data. All of that is hallucination. Those are ghost signals. None of that explains an overnight 18% margin shock synchronized with a vertical reversal precisely at the most critical breakout level in the entire silver structure. That is not coincidence. That is intervention. The silver market is not a free market. It is a control mechanism. Price is not discovered. It is enforced. The futures curve is not reflecting physical reality. It is suppressing it. When silver approaches the threshold where physical demand overwhelms paper supply, the exchange itself becomes the enforcement arm. Margin is the weapon. Liquidity is the target. The algorithm doesn't care about your chart patterns, your indicators, your support levels, or your feelings. It cares about one thing, containing price before the derivatives tower collapses. When price velocity exceeds tolerance, the system triggers a volatility containment protocol. That protocol is simple. Increase margin requirements, force leverage longs to liquidate, trigger stop cascades, flip momentum, and let the media blame profit-taking. This is not theory. This is how the casino is wired. The banks know exactly how much leverage exists at every price level. They know exactly how many contracts must be forced out to reverse trend. They know precisely where the dominoes are stacked. And they know that the public is trained to interpret mechanical liquidation as market weakness. That illusion is the cover. The V-shock you just witnessed is a classic algorithmic pattern. Price drives higher, volume explodes, open interest swells, physical tightness increases, and then suddenly the system snaps. Not because buyers disappear, but because collateral demands are changed. The market is not sold, it is liquidated. Every silver bull market ends the same way. Not with exhaustion, but with execution. This is why mainstream analysis is useless. They are analyzing the weather while the building is being demolished from the inside. They don't understand the plumbing. They don't want you to understand the plumbing. Because once you understand the plumbing, you stop believing the price. The futures price of silver is not the price of silver. It is the price of paper risk inside a broken clearing system. The real price is forming somewhere else, in Shanghai, in Tokyo, in vault inventories, in industrial contracts, in private settlements, far away from the glowing screens you're being hypnotized by. And the reason this matters now is because this intervention came at the exact moment the paper market was losing control of the physical narrative. That is when they always strike. That is when the rules change. That is when the mask comes off. The system is not stabilizing, it is fracturing. The margin hike did not make silver safer. It made the derivatives structure more fragile. It accelerated the exodus of rational capital. It exposed how thin the real liquidity is. And it confirmed what many of us have been warning about for years. The silver market is no longer a market. It is a pressure vessel. And pressure vessels do not fail quietly. The Shanghai and Tokyo numbers are where this entire operation collapses under its own weight. Because once you step outside the paper illusion of New York, once you stop pretending COMEX is the center of the universe, the math becomes catastrophic for the system. Here's the reality they cannot print on CNBC. In Shanghai, silver is not trading at $71. Depending on contract month, tax structure, and conversion basis, the implied physical price is pushing $89, and in some cases well north of that. In Tokyo, industrial settlement bids are even higher once you strip out the derivatives, smoke, and calculate on a delivered basis. Meanwhile, New York sits there, artificially pinned in the low 70s, like a corpse propped up in a chair. That spread is not a market. That spread is a fault line. In a functioning global commodity system, arbitrage eliminates that spread instantly. Metal moves from cheap markets to expensive markets. Price converges. That is the first law of commodities. But the metal is not moving. The price is not converging. And that tells you everything you need to know. The arbitrage mechanism is broken because the metal does not exist in sufficient quantity to perform the arbitrage. You cannot ship what you do not have. The paper market in New York is trading claims. The Asian markets are trading metal. Those are not the same product anymore. The moment you understand that, the entire narrative flips upside down. The reason the spread is growing instead of shrinking is because every attempt to move real silver out of Western vaults is colliding with an empty shelf. Eligible inventories are being shuffled, registered as being drained, bars are being rehypothecated, recertified, relabeled, and delayed. Delivery times are stretching, premiums are exploding. None of that shows up on your futures chart. The only thing that chart represents is how aggressively the system is suppressing panic. Every dollar of divergence between Shanghai and New York is a confession of insolvency. If silver were truly worth $71, every industrial buyer on earth would be sourcing from New York and shipping to Asia for instant risk-free profit. They are not doing that. They are paying the premium. They are fighting for supply. They are locking contracts months in advance. They are bypassing the exchange completely. Because they know the truth. The price you see is not the price that clears metal. This is why the margin nuke happened now. The divergence had reached a level that was mathematically unsustainable. The paper shorts were about to be obliterated by the physical reality. So the exchange stepped in and changed the collateral rules, not to protect the market, to protect the shorts. The system cannot allow convergence because convergence means default. It means mass delivery failure. It means the end of paper silver as a functioning instrument. So instead of letting the arbitrage close, they blow up the leverage. They don't fix the leak. They lower the pressure gauge. This is why the V-shock is not a correction. It is a containment maneuver. They are buying time. They are draining speculative oxygen. They are forcing weak hands out before the next surge hits. But the physical math is still there. The spread is still there. The metal is still missing. And that is the part the media will never explain. What the public never sees is the plumbing behind these moves, the quiet machinery humming underneath the trading floor where the real panic lives. While the headlines scream about inflation data and employment numbers, the Federal Reserve and the primary dealers are conducting emergency operations to keep the financial bloodstream flowing. And the timing of those operations lines up perfectly with what you just witnessed in silver. In the days leading into this margin strike, the repo market lit up. Not the sanitized version they publish, the real one. Overnight injections, term operations, tens of billions moving through the pipes, sometimes 17 billion, sometimes 34, sometimes more, on no news, no crisis, no explanation. They call it liquidity management. In reality, it is cardiac arrest prevention. Because when precious metals start moving, it exposes the entire leverage structure of the banking system. Silver is the canary that forces collateral stress into the open. As silver price rises, the paper shorts bleed margin. As margin bleeds, the banks run for funding. As funding tightens, the repo window explodes. That is the feedback loop. This is where the blue whale flip enters the story. For years, the largest institutions sat massively short silver. Not because they believed in the trade, but but because they were the house. They suppressed volatility, they harvested premiums, they controlled the casino, but as physical supply vanished and industrial demand surged, the trade became toxic. The short side became a death trap, so the whales began to rotate, slowly at first, covering here, accumulating there, turning from suppressors into hoarders. The biggest entities in the system are no longer betting against silver, they are positioning with it, but you cannot flip that kind of exposure quietly. When the blue whales move, the ocean reacts. Liquidity gaps appear, funding costs spike, collateral chains snap. That is when the Fed enters, pretending it is just smoothing volatility, when in fact it is bailing out the entire structure in real time. The margin hike was the exchange's contribution to that bailout. It was not for retail. It was not for stability. It was for the banks that were about to be margin called into oblivion. The public sees price drop. The institutions see survival. Every injection, every emergency facility, every quiet backstop is a confession that the system is running out of slack. And silver is the pressure test they cannot pass without cheating. Because unlike bonds, unlike equities, unlike currencies, silver has a physical floor. When the paper lies collapse, the metal remains. You cannot print ounces. You cannot digitize atoms. You cannot settle a refinery with derivatives. The deeper this gets, the more desperate the interventions become, and the more inevitable the outcome becomes. What finally detonates this entire structure is not speculation, not retail, not hedge funds, not even sovereigns. It is industry. Industry does not care about your chart. Industry does not care about your margin. Industry cares about one thing, input supply, and silver is now crossing from commodity into strategic material. The technological demand shock underway is not being priced, it is not being reported, and it is not survivable for the current paper system. Start with the battery revolution. Solid-state batteries are moving from prototype to production. These are not your old lithium-ion packs. They use silver-based conductors, silver contacts, silver paste at scale. Certain designs require close to 1 kilogram of silver per vehicle. Multiply that across global auto manufacturing, and you are no longer talking about ounces. You're talking about national stockpiles. Then comes the solar grid. Then comes military electronics. Then comes AI hardware. Then comes 5G and 6G infrastructure. Then comes medical systems. Then comes weapons platforms. Silver is not a luxury metal anymore. It is critical infrastructure. This is why China's export posture has shifted. This is why strategic materials are being classified. This is why supply contracts are being locked in long term. This is why Western vaults are being vacuumed. The COMEX does not show you the drain. The LBMA does not show you the drain. But the refineries do. The shipping manifests do. The industrial procurement contracts do. The metal is leaving. COMEX registered continues to fall. Eligible is being cannibalized. Bars are being converted, shipped, recast, and disappear into private hands. Asian vaults are filling while Western vaults echo. This is the real price signal, physical exit. Asahi, JPM, HSBC, Brinks. The movement is accelerating, not because of speculation, because the pipeline is emptying. And once the pipeline empties, the exchange becomes a theater. That is why silver is becoming unobtainium. That is why premiums are exploding. That is why industrial buyers are bypassing the futures market entirely. That is why delivery times are stretching. And that is why the margin nuke was inevitable. Silver is not just a metal anymore. It is a war material. When something becomes critical to national security, price suppression ends. It only continues until the physical stock runs out. And we are approaching that line. Everything you are watching converge right now points to 2026 as the inflection year. Not because of some mystical cycle, but because the physical math stops working. The system cannot print metal. It cannot digitize atoms. And once the vaults are functionally empty, the entire paper narrative collapses. This is where your battle plan comes in. First rule, the 5 and 200 rule. If silver is below 5% of the Dow, the system is lying. If silver is below 200 ounces of gold, the system is lying. Those ratios have defined every monetary reset in history. They are screaming right now. Second rule, digits to atoms. You're exiting the matrix. You're converting electronic promises into physical reality. You're stepping out of the rigged casino before the lights go out. Third rule, no counterparty risk. If someone else has to perform for your wealth to exist, you do not own wealth. You own hope. And hope dies fast in financial Armageddon. Fourth rule, ignore the noise. They will tell you silver is volatile. They will tell you the rally is over. They will tell you the economy is stabilizing. They will tell you inflation is falling. Every word is gaslighting. Fifth rule, time is the weapon. You're not trading this. You're surviving this. You're positioning for the other side of a currency collapse. The CME margin nuke was not the end of the move. It was the opening salvo of the final phase. The system is cracking. The interventions are escalating. The physical market is screaming. The derivatives tower is swaying. This is the part of the movie where the characters realize the building is burning, but the orchestra is still playing. If you understand this, you're already ahead of 99% of participants, because the war is not for price. It is for metal, and metal is leaving the system. I will see you on the other side. Like, subscribe, and share.